Thank you, Charles, and thank you to everybody for dialing in and to listen to this. So, as Charles said, what we thought we're going to do is go through the key findings of the question coming out from the survey. It's a survey that we do every year, so the themes are fairly well rehearsed. But what we've done this year is that we introduced an ESG dimension to a lot of the questions. Just bearing in mind that 2019. In our view, was a turning point where ESG is fully in the mainstream. So that really is sort of hovering over a lot of the themes that we look at. But also, again, as Charles mentioned, we're going to, bearing in mind the current circumstances that are so, nothing is an exception to being affected by that, and certainly not the AGM season and dialogue. We'll try to incorporate some of these issues that we're seeing coming through discussions between companies and investors now. So we will do that, and we'll go through question by question. But before we start, perhaps to hand over to Kiran, who will talk us through the methodology for preparing the survey this year.
Great. Thanks, David, and hi to everyone who's joined. Thanks for participating. And so, yeah, this is our fifth annual investor survey. The background is when we kicked it off back in 2016, it was to give a bit more color about investor perceptions and how it might impact, what issues might impact the property season. But as that's evolved, we've broadened the questions. ESG has become much more prominent, so we've opened up the questions in this way to cover a broad range of subjects. We had responses from 41 institutional investors, representing about 26 trillion of assets under management. In terms of the geographical distribution, you can see that 39% were UK, 27% US, Europe 8%, excluding UK, and we had a bigger number in the rest of the world, around 26%. That has a high number of Japanese and Australian investors that also participated, so it gives a more broad cross-section in terms of the type of investors that we had, investment style and location. We also, in the statistics, think it's important to highlight that the active versus passive, in terms of the respondents, as we know, passive has increased exponentially over the years, so it's to give that feel that we have a balance of the type of respondents that have come there. So this year, 85% of the respondents had a balance of 85% active with 15% of a passive position. 10% of the respondents were almost purely passive only, and remaining 5% of the respondents were 100% pure active investors. And there you'll see there's the investor type again: 54% institutional investors, 29% pension funds, and 17% investment managers or asset owners. And I think one important point to make is that in terms of all the respondents, they're all investment decision makers or voting decision makers. So that kind of wraps up the methodology side.
So looking at the first question, and it's sort of the entry into the survey, which is to what extent investors integrate ESG when compared with their position last year. And you could see, I mean, it's quite interesting to show it in a pie chart, because it's 100%. Everybody said, yes, we are integrating ESG in the investment decision making to a larger extent than we have 12 months ago. And perhaps in sort of initial superficial look, you think, well, that's a bit of a trick question. It's hardly surprising. But actually, bearing in mind a couple of things. One is that these are all mainstream investors. These are not sort of sustainable funds, etc. These are the largest global institutions. So I think that's quite an overwhelming conclusion to see. And now, reflecting on what we're seeing, and it's still very, very early days to draw, I think, big conclusions coming out of what we see in a shifting agenda now. But the early indications are this is not going to change. The centrality of ESG in the way that investors brought it into their agenda is not going to change. And we're saying it based on some statements, whether it was the letter from State Street and a number of other investors that expressed commitment behind these issues. I think maybe we're going to see some shifting in priorities of ESG subjects, and we're going to talk about that and mention that as we go through the study now. But there's a centrality of ESG. Early indication is this is looking to stay. And looking at what are these themes, and these are the findings coming out of the survey. The questionnaires went out around November, December, turn of the year, and you see that climate change is by far the most important themes for investors. So that's one interesting point to draw. I think the second interesting point to draw, so reputational risk, just to be clear, what we see in that is, so reputational risk are all the issues that are perhaps not operationally material to companies, in the sense that the actual financial impact is not financially material, but actually they create an oversized reputational impact that can perhaps linger on and be quite detrimental from an investor perspective. So think some of the themes that we see on the sort of the social side of ESG, whether it's human rights or some other things, where if you isolate them from an operational perspective, you think, well, this is not something that has a massive material, but actually we know that companies that get caught out on that, or companies that get wrong the oversight of these issues, may find themselves in some serious troubles with their investors and with other stakeholders. So that's hence the reputation of taking such an important thing. The other point I want to just note here is the human capital management, which we can see comes up as a third most important. 36% of the respondents indicated this is an important issue for them, and 41% are allocated a medium level of importance. This, we believe, based on indications over the last weeks, is going to rise in importance. And there's been a number of indications that investors are now focusing on issues to do with how companies are managing the human capital, whether it's health and safety or whether it's other aspects that are proving to be quite critical. And we suspect that the importance of this theme is only going to go to rise in the coming months and as we go into the next season.
Thanks, David. And yeah, and if you think about these the importance of these ESG subjects, as just explained in a very explicit way, I think then we're looking at how investors want to influence these changes and these expectations. And so, we pose the question: what do you think is the most effective way for investors to influence board policies and decisions? And as we're seeing that right now in the current climate and the impact of COVID-19, engagement at board level received 91% support, engagement with management 59% support, and yeah, that's the kind of on the ground and the message we're getting from investors, and the importance to engage, to discuss and understand how boards are navigating the situation. Do they have the right risk mitigation processes in place, the right discussions taking place with stakeholders, etc., etc. So that's quite clearly highlighted here. I think looking at the other responses, individual votes against director or directors, collaboration with investors, putting forward a shareholder proposal, public disclosure of vote decisions before AGM. I think it's notable to point out that these 4 or 5 other solutions, investors are taking advantage or utilizing these options, especially when they maybe are smaller shareholders and they want a voice and that they believe their voice is not being heard. Then you might see more collaboration from investors to build a message. I think it's important for companies to understand and listen to a variety of views and perspectives.
And just to add to that, actually, the collaboration with investors. So we've seen in past months and last year a number of high-profile initiatives and investors, including the largest investors, becoming more willing to take part of these collaborations. And that I'm thinking about initiatives such as Climate Action or 100+, or some other initiatives on human capital. You have to wonder what. So now, as we're shifting towards, certainly now in the coming months, more different formats of engagement, the role of collaborations of initiatives is only going to be increased, because it does allow. What it does allow is to investors, as Kiran was saying, some of the smaller, the medium or the smaller investors, to leverage a lot more influence and to bring to the table more capital, as it were, in discussing these issues with companies.
Yeah, and continuing in this section of questions on investors' perception on ESG risks and integration, and it's the first year we asked a specific question around climate related risks and opportunities, as in the previous years, it was 2017 where climate change became one of the key engagement focus areas based on our survey, and so we decided to kind of see what are the key expectations within climate-related disclosure. So, we asked them how could companies improve their related disclosures. Clear connections to financial risks and opportunities was by far overwhelmingly the top answer, with 91% of respondents. Greater clarity around the process by which companies identify risks and opportunities got 68%. And I think just a couple of points from my side is that we are seeing more investors endorse standardized frameworks such as TCFD, and we'll talk about that a bit later. More investors are shifting capital to sustainable investment strategies, and I think that correlates with the overwhelming response in terms of wanting to understand clear connections to financial risks and opportunities. Again, during our conversations and engagements, we're seeing more and more investors, not surprisingly, asking boards how they demonstrate if their strategies in line with the Paris Climate Agreement. Perhaps you could say it's more focused on specific sectors, but beyond energy, utilities, materials, industrials, there are other sectors that are being, these questions are being posed. And also, I think if we look at the AGM, we are seeing a couple of investors that where they're kind of putting their message through a vote, particularly where maybe some companies have a poor track record of ESG practices or improvements, and some investors are voting against key agenda items to make their point known. So as discussed, and we've linked this in with the forthcoming AGM season, but every year we do ask what are the 3 top sustainability topics that you will focus on when engaging with the board in 2020. Again, climate change was resoundingly the top answer, 91% of respondents. Second was human capital management, 64%. Corporate purpose and human rights, both equal at 36%. And again, I think you can't underline the fact that climate change, again, as I said, in 2017 was one of the top answers in terms of wanting to engage with companies to understand their approach and strategy. It was only around 50% of respondents at that stage. So the fact that fast forward 3 years has moved to 91%, I think is quite a strong message. And again, we are seeing even today in discussions and engagements that are taking place, investors asking board members, of course, more questions about the impact of COVID-19 and how they're navigating the challenge with key stakeholders, and of course, how they are taking into consideration workforce challenges, etc.
Perhaps just to add in terms of sort of how this map of themes is sort of tilted by the current developments. So I mean, the interesting one, climate change is a huge one, and I think it is here to stay. It's not going to be going away. However, it probably will take a bit of time to sort of reorganize some thinking around what it means and how to reorientate approach to that, and maybe also some other things come into play here, the oil market disruption that we're seeing. So that might be sort of taking a pause, a momentarily pause in terms of intensity of it. But where we are seeing the rising themes, and Kiran, you talked about human capital management. I think another one here too that is an interesting one is supply chain management, because we're already seeing more intensity of focus on that in a number of markets, whether it's governments and whether it's businesses asking questions about control over supply chains and being able to ensure that the supply chains are more resilient to disruptions of the sort that we're seeing now. So I would think if you were redrawing this based on noise and not just noise, on focus of discussion over the last 2-3 months, we probably would see relatively more discussion on human capital management for sure, and probably more supply chain management as well. Moving on to talk about another theme which is always very, very quite prominent when it comes to AGM seasons, and that is executive remuneration. And so we know this is a big issue when it comes to voting. What we did with the question this year is we wanted to drill a bit deeper into the reasons behind potential controversies around pay. And a couple of interesting points here. But by way of background, just to say, this is a global survey, and when we ask these questions to investors, as we've seen, they're coming from different backgrounds. So this sort of reflects an international consensus more than it is reflecting a sort of a deep one market view. But clearly misalignment of pay and performance is up there. This is how investors see pay primarily. This is an indication to management how investors want them to incentivize them to run and manage the companies. And there was a lot of talk more recently about management experiencing the same sort of experience that shareholders are with the stock. So that's clearly a primary issue. Then we've got some issues to do with disclosure, and that does vary market by market, because disclosure regulations vary market by market. Well, where there is no mandatory disclosure and where companies don't provide disclosure on performance criteria, on LTIP and other elements of disclosure, clearly investors become, it becomes quite a controversial point for investors. One thing to note here is the role that overall pay quantum play in investors' decision on votes. Historically, historically more than 2-3 years ago, that has been probably a non-issue for many investors, because they would argue that the role of, the issue with pay is alignment. It's less about actual level of pay. Level of pay would sort themselves somehow by market. But increasingly, this is becoming an issue, and you could see that now we have 43% of investors that indicated this is an important issue for them. And in other words, that sort of takes the pay from a governance or pure governance issue to a little bit more with a social thing to it, a thing with a social thing. And we're certainly seeing that loud and clear over the past few weeks. We've seen that in the UK, we've seen that in other markets in Europe, in France and elsewhere, where the level of pay of companies to executive pay is scrutinized in these sort of very social eyes. How does the pay levels for executives measure up when you compare them to what the company does elsewhere in the workforce? Again, on its own, it's not a new issue. We had that last year in the UK quite clearly with the issue of executive pensions, and investors pushed for level of pensions to executives that is in line with employees. But this is becoming, this intensifies now, certainly.
So we move on to the third subsection, which is activism, and this is a question that we have put forward every year, and to understand, I suppose, with the lens is focused from the stewardship ESG community, but I think they have a much more important and involved role in part of that decision-making process when proxy contests or active situations arise. So we pose the question every year, in addition to poor financial performance, what factors might lead you to support an activist? We have put in brackets there, corporate activists or ESG-driven civil society activists. As you'll see as we go into this, that ESG is starting to get a bit more involved in activist situations from a social sense. You'll see that weak governance practices was the top answer with 64%. This is up 31 percentile points from last year, so that's a huge uplift. Misallocation of capital, 50%. This has been quite consistent over the last 3-4 years, and of course that maybe is less surprising. But I think notably we wanted to flag ESG stakeholder risks, which was a new entry in terms of an answer option this year, and this was based on the trends we're seeing in the market. And so that jumped up to third spot, which I think is quite notable. And I think some background for us here really is to say risk mitigation and sustainable investment opportunities has taken on kind of, let's say, a whole new meaning. Investors get more and more questions from clients about how they incorporate ESG into investment decisions. And if we look at some of the more recent situations, we're seeing a lot more pressure on companies in terms of how they disclose their strategy, or if they have targets on achieving, reduced carbon emission targets. So, I think that's starting to get a bit more traction. And institutional investors, from different stakeholder pressures are paying a lot more attention to this point. And we move on to the final kind of section of the survey response questions, which is corporate reporting. And again, every year we're also looking at fixed income and its link with ESG and how investors are navigating that approach and strategy in terms of engaging with companies on risk. So we are asking, when assessing fixed income ESG risk and opportunities, do you look beyond credit rating agencies? And we've included a range of different structures: ESG frameworks, ESG rating agencies, and the UN Global Compact Principles, which is a norms-based strict guidelines, which we noticed many investors do incorporate into their processes. So it's very interesting to see that 43% of respondents say they use all of the above. And I think what is also quite notable is only 7% said they didn't use ESG frameworks and data sources outside their credit rating assessments. So that again is quite a strong message that we're seeing from investors.
So the next question that we asked is to do with a link between sustainability as a theme and it being a voting item, because the issue is for many investors is when the discussion with companies was mainly around corporate governance, there's a very clear route for investors to express their views, and that is the ballot and the vote at shareholder meeting, whether it's directors' elections or vote on accounts or vote on other issues. When it comes to sustainability, the routes to voting implications are more limited. And so what we asked investors in this question is, do you think that at the moment you have sufficient say in terms of voting on the company's sustainability performance? And the results here are mixed. As you can see, 30% said that, think that the current level of influence is quite enough, that's fine. But equal 30% said they would have liked to see a dedicated say on sustainability vote. And just to note that we've seen last year in Europe, we have the directive on non-financial information, and Spain, the way Spain applied it is by mandating vote on non-financial information for all Spanish listed companies. So we've already been through that vote. So investors sort of who understand that market realize what that means. But the interesting thing is that the way that investors see the opportunity to vote on these on this non-financial information is not so much, not at all at are they happy or unhappy with the way that the company performs, but actually it's a vote on the robustness of the figures. Very similar to how you look at financial numbers and reports, where the vote is not on whether the investor thinks that the profit is not sufficient or anything is not satisfactory. It's actually on the validity of arriving to these numbers. So that's an interesting point to make to note here. So moving to some of these frameworks, and we touched on a number of these names earlier. I think what this question does is really test the temperature at the moment, or where the momentum is in terms of frameworks and applicable standards. Because one of the things that very often we hear from our clients, from companies, they struggle with is the sort of multiple frameworks, multiple standards for accounting for things, how, which one they should do. And so we thought it'd be useful to point that question to the respondents and get to see what their view is. And very much the momentum, as you can see, is behind the SASB, which is an initiative that started in the US, but especially in 2019, we've been seeing a drive and push and to be recognized outside in other markets as well. And as Kiran said, TCFD, which is a standard for reporting and for managing of climate change risks, that is started as an international, as a global standard coming out of the G20 and the Financial Stability Board, and now is increasingly accepted as a regulatory standard in various markets. Of course, in the UK, that's going to become a regulatory requirement from 2022, where the FCA released a consultation a couple of weeks ago asking for comments around how exactly to apply it in the UK. And the initial approach, it looks like it's going to be comply and explain, but it will be something that companies have to address. And so one last comment, perhaps on that, again alluding to previous comment that we made, this is no longer something that is addressing only high emitting industries. The standard and the FCA guidance applies to all UK issuers. So moving on to talk about another theme, which as we've seen, it's fairly high up there in terms of themes, and that is human capital management. Now, unlike climate change, where more or less we're seeing some standards establishing themselves and ways of reporting, and companies understand how to address and how to how investors approach it. When it comes to human capital, at the moment, I'd say the gap is quite noticeable in that it is something that we know is very important to investors, but the level of disclosure is not very consistent, and actually the consistency of disclosure is just not there yet. So we asked investors, how do you, when you look at human capital performance of companies, how exactly you're looking at that? And you can see here the responses. Tone at the top and board involvement is up there with 95%, and linking to that, of course, is how would you assess as an investor what is the tone of the board and tone of the top, and how the board approaches. Well, the natural answer to that would be, well, by meeting and by engaging the board. So that's one thing. And you see further down health and safety indicators and some other indicators that are perhaps further down in terms of importance for investors, because some of them are now more regulated and therefore mandatorily disclosed. I'm thinking gender and other gap disclosure.
Thanks, David. And to finish the corporate reporting section, I think another theme that we've seen a lot of traction in the last 12 months, particularly, is around corporate purpose. Let's say it's not a new topic, but it has gained momentum. I think there has been perhaps some significant corporate scandals in the last few years in key sectors, impacting reputational risks and of course value destruction. And then we have also seen the impacts of, so I think there's been a new concept, some newfound attention. There's a release of a statement on the purpose of cooperation by the Business Roundtable. So there has been activity around corporate purpose. Maybe you would say companies are still not fully clear on the exact implications, and there is some little consistency, but like a lot with the ESG themes, we're seeing investors take voluntary action on what they expect of companies. So we have posed the question, what topics should the company include when explaining their corporate purpose? Stakeholder engagement approach and outcomes received the highest response, 81%, which was quite a strong message, and second, again, quite a high focus of importance, evidence of a link between pay incentives and corporate purpose. And I think we're starting to see investors continue or increase referring to corporate purpose statements. Of course, this may be market specific, where there might be a more importance to comply and explain. But we're seeing more questions posed around if it's aligned with Paris Agreement, for example, and if any kind of non-compliance has an impact. That's certainly something we're seeing. And on the evidence of link between pay incentives and corporate purpose, it's interesting. I think for quite a few years, we're seeing a lot of discussions between investors and companies, a lot of initiatives trying to find the right measures to be able to target and understand the link. But we are seeing much more focus now on ESG targets, and probably more with the environment side in terms of expecting companies to have this as part of their incentive plans, maybe linked to GHG emissions, for example. We're seeing investors kind of saying, well, if they're able to put this kind of information together and measure it, it shows a sign, perhaps, that from a cultural perspective, they're changing their behavior to a more long-term thinking process.
Thank you. I think, Charles, we've sort of reached the end of the part where we talk about the finding of the survey, and I mean, we try to sort of place as much as we can sort of insights and what's happening now, but we have now a few slides around specifically what we're seeing in the last few weeks with the AGM season entering at the time of the COVID-19 crisis. I don't know whether we want Charles to take a few questions now, or do you prefer to go in terms of timing? We've got about not that long to go.
I think unless there are any specific questions now, why don't you carry on, David?
Okay. Sure. So as you know, with this extremely disruptive, unprecedented, all these adjectives have been used a lot in the last few weeks, happening at the same time as we're entering the AGM season, what we found that companies sort of encountered all sorts of issues. The first one, or the more immediate ones, was about how to conduct AGMs and asking questions about physical AGMs versus virtual versus all sorts of hybrid means between that. So that these sort of questions needed addressing. Then the next thing that's happening is, of course, the pre-AGM engagement, and as we know, the volume of engagement grows quite high before the season. There's sort of ad hoc or last-minute engagements to explain and clarify the engagement. So that was sort of happening at the same time. But I think where we are now is we moved into another to the next phase, which is actually, okay, what is the content of these discussions and engagements on things as we entering another phase, the next 3 months, the next 6 months, and how is the COVID-19 situation changing the actual content of the dialogue. And we've seen issues around pay, we've seen issues around dividend at the moment, very topical, capital raising, etc. And we'll try to touch a little bit on some of these things. So on AGM and holding AGM, investor preference is certainly for AGMs not to be postponed. I mean, that is regarded as quite disruptive. I mean, if it happens, or if a company reaches the conclusion that it has to happen, then the expectation was very much for companies to provide a detailed rationale for the decision and be very transparent about the timeline and for the postponement. So we've seen that, and when you look at the numbers, and there's been a number of surveys conducted into that, it looks like we've not had, all in all, internationally, we've not had that many postponements. In some markets, we've had more than others. I'm thinking Germany, some markets in Asia, but largely companies opted for converting meetings to more virtual means than they have to postponing them. We've seen, the other thing that we have seen is that continuity plans for investors to go ahead with actual votes and has gone largely quite well, because voting, as we know, is done now mostly on online platforms anyway. I mean, there is an issue there with retail investors, and we know that that is something that investors are raising with companies. If a meeting is shifted towards a hybrid or a virtual route, how is the company addressing the need to listen and to give an opportunity to vote for retail investors? So we've seen companies having a lot of thinking around that. In terms of engaging with investors, Kiran, I know you had a lot of experience with that in the last few weeks. Certainly the sort of starting point, quote unquote, is business unusual. You know, if we had something booked for a face-to-face meeting, of course we'll convert it now to a call or to another means, but there's no change on that. I don't know whether you have anything to add on that.
Yeah, no, I think you covered the main points. I think the message at the beginning of this pandemic and an unprecedented situation was there was a little bit of disruption, but where the road shows and deal shows were, of course, as you expect, physical. You know, those were obviously postponed. But in our case, in terms of the ESG side and governance and the AGM season, you know, most investors have adopted very quickly with little disruption, and just reiterated the message to companies that, you know, from a process perspective and engaging, it is business as usual, and try to convert everything to conference calls and video conference calls, etc. And that, from our perspective, our experience has worked very smoothly and continues quite normally. I think the other message that they wanted to emphasize when they used the term business as usual was, whilst they were of course keen and sympathetic to understand how companies are managing the key challenges, workforce risk, etc. I think they wanted to reiterate that it's also business as usual in terms of their approach to climate change, etc. So, you know, we still see that these questions are being asked frequently, and they want to understand how companies are integrating or adapting their strategy, and transparency and explanations need to be a bit more detailed. I think that's kind of the messages that investors want to give.
Okay. And in terms of investor messaging, we put here on a few of the notable statements that we've seen. There's been, I mean, this is coming on a daily basis. So since we've done that last week, we've already seen something from Federated Hermes yesterday on their approaches to stewardship, and Newsyn in the US added something. So it's worth going through that, or let us know if you want, and we can share with you some of these things. I'm not going to go through the details of this. I'm just conscious of time, Charles. Please do let me know if you want me to hard stop here. But you've got some of the highlights here. Moving on to talk about executive remuneration and ESG, I'm really just going to say one word on that because we've talked about it. It's worth seeing that this is now high on the agenda on a number of markets. Slight nuances in the way that it's dealt with in different markets. And also some sort of different, slightly nuanced approach for investors in different markets. We've seen in the UK over, I think it's now the figure, over 30 FTSE 350 companies announcing one or another type of measures, where we try to look at what people do and find, is there a consensus? It looks like we're talking about 20–30% fixed pay cut applied to executives and also to non-executives. So that's one thing. We started with a sector bias in that airlines came into this first, house builders, but by now we have announcements coming out from banks and insurance linking to cuts of dividends in those sectors. So I think this is pretty much now cutting across dividends. I think I'll stop there, Charles, and hand it over back to you in case there's anything we need to say before wrapping up.
No, perfect. Okay, thank you very much, David and Kiran. As always, very insightful and hopefully very helpful comments on what's going on out there and what investors are thinking. If anyone wants to ask any questions now, please feel free. If nothing comes to mind, obviously, please just contact us. We'll get back to you. If you feel any of your clients need any advice on the governance side, we'd be very happy to help there. Even if it's just a phone call or anything like that, we'd be delighted to help out in any way at the moment, because we know that companies are struggling to adapt to what's going on out there. But if there are no further questions or any questions, I think what we'll do is we'll wrap it up here. You will have access to the slides. I think you might already have seen the slides from today. We've done a recording which we'll be posting at some stage as well. So thank you very much, everyone, and looking forward to catching up in the near future. Cheers.